Hey guys, TommyBryson here, and this video is for all the planners out there that basically want to make sure before they go ahead and walk into a bank and ask for a mortgage that everything checks out. That way you are a textbook person to actually go ahead and get the mortgage you actually need and get a pre-approval letter. This way people know, hey, this guy is serious or this girl's serious. They actually have money and actually have the backing to actually get into things, okay? And by the way, people think that, hey, if I have a 500 credit score, I can't get a mortgage. The answer is that's not true. People think, hey, I had a good year and this year I actually have a good income. The reality, that does not mean you can actually go ahead and qualify for a mortgage. And that's why today I'm going to tell you exactly everything you need to know to be a textbook customer to get that pre-approval letter and also qualify for that mortgage you actually need to buy that home you actually want, okay? Now, if you guys are new here, I post videos every single day, so you should also subscribe, hit the bell so you're notified. On top, I also destroy the like button for the YouTube algorithm. Now, the very first thing is this, guys. The first thing people think about when it comes to a pre-approval letter or being pre-qualified, the answer is my credit score. It needs to be super, super high. In reality, that's not true. There are a lot of options out there when it comes to, hey, my credit score is not that high, but this loan type actually allows me to actually go ahead and qualify for the home I actually want to go ahead and buy. On top of that, it's not really about having a credit score. It's more really about, hey, I don't have a bad credit score, because you can actually have no credit score and still qualify for a mortgage. And I'll tell you how later on in the video. But for right now, okay, whenever it comes to a credit score, it just makes things a lot more easier to a lender to see exactly what are the odds of them actually getting their money back, okay? That is the entire goal with your entire credit score. So for example, when you have a 500 credit score, you might think you don't qualify for anything, but in reality, if the government's actually going to go ahead and say, hey, we're actually going to guarantee this loan, for example, an FHA loan, a VA loan, or other types of loans out there, for example, a USDA loan, the answer is you can actually go ahead and qualify for those mortgages if you have a credit score between 500 to 580. What really matters is basically that you don't have a bad credit score, meaning, for example, hey, I have a bad payment history, meaning I don't make my payments on time and sometimes I don't make them all. And on top of that, utilization. How much of your credits are you actually using? Are you basically borrowing all the money you can, or are you basically sliding through with like a 10% utilization rate or 5% utilization rate, okay? And by the way, utilization is basically, if I give you a $1,000 credit line, if you use $100, utilization is basically 10%. If you use $500, that's 50%. If you use all 1,000, you're at 100%. And basically that says, hey, this person might be at risk because basically they're borrowing all the money they actually can. And that's actually not good, believe it or not. But on top of that, guys, okay, let's say you don't want to get an FHA loan or any loan guaranteed basically by the government, right? You want to get a conventional loan, meaning it's based on you're guaranteeing it. So the bank actually has to do their homework. In reality, your credit score is going to be very important. Anything above a 740 is usually going to be awesome. Perfect. Anything above like a 750 to 780, in reality, you get the same benefits as an 800 or 850 credit score. So don't even try to go that high. You actually don't have to, okay? Now, again, remember I told you that basically you can actually go ahead and get a mortgage without needing a credit score? Well, here is how that actually works, okay? What they need to do is something called manual underwriting, meaning instead of looking at your credit score for all the information, they have to look at you and you have to provide all documentation. That way they can paint a picture of what type of borrower you actually are, okay? Basically, let me see your tax returns, your pay stubs, your bills. Let me see your whole payment history on everything. And that way I can paint a picture and see if you can actually go ahead and afford all of this debt in a way. And that's basically what Dave Ramsey teaches. Like, don't have a credit score, you don't need it. But in reality, my advice is this. If you want to have a good credit score to make things a lot easier and a lot faster, in reality, just go out there and get 3 credit cards, okay? And on each credit card, just put a small bill on it. For example, Netflix, your internet bill, or like iTunes, whatever it is, okay? And then set it to pay in full every single month. That way, you don't get into debt, you don't pay any interest, but you do build up your payment history. On top of that, your utilization actually stays long, which basically means in 6 months to 12 months, you will have a pretty good credit score. But if you already have credit cards, just pay those off in full right now, as fast as possible, and then do the technique where you basically put one small bill on each credit card, and that way you build your credit score up in the long term, okay? But I never ever really recommend you go ahead and have a massive balance and all this stuff. Usually that is going to be a bad idea. So overall, okay, credit score is important, okay, but it is not everything. If you're brand new to credit, that's fine, you can still qualify. If you have no credit, you can still qualify, but it's when you have terrible credit, when you actually have a problem, missing payments, charge-offs, bankruptcies. For example, high utilization rate. They look at that stuff and say, for example, hey, this person might be risky, and then they might not actually go ahead and approve for anything. So usually you want to go ahead and pay off your cards. You want to go ahead and settle on the loans you actually have, the charge-offs or whatever it is, and that way you build your credit score up or have nothing bad going on, and then you're actually good to go in the clear to actually go ahead and apply for that mortgage if that's what you actually want. Now, the second thing they're going to look at is basically your debt to income ratio. Now, this means basically, hey, how much income do you have, and how much of that income can you use to basically settle all your debts or, for example, your bills. So, for example, the usual ratio they actually want is a 43% to 47%, but some loans actually offer up to a 50% debt to income ratio, meaning if I have $1,000 in debt, how much income do I need to pay that off? In reality, if it's a 50% debt to income ratio, well, just divide 1,000 divided by 50%. In reality, it's going to give you around 2,000. If you multiply that across the year, it means you need around basically $24,000 worth of income to basically cover that entire $1,000 worth of debt every single month. That's how crazy things actually are. So in reality, the more debt you have, the more income you need to actually be able to pay everything you actually have, okay? That is the idea. But tell me why, okay? Why half my income or 40% of my income? Why not just take the whole thing and say, hey, you can actually go ahead and pay it for it? The answer is because basically they know for a fact, hey, yes, you're paying the mortgage, but you also have bills, food, expenses, cars, right? So gas, everything, right? So they know for a fact you can't just say, hey, I make $2K a month, I want a $2K mortgage. Well, what about your car? What about your gas? What about your insurance? What about all this stuff, right? So in reality, that's why they give you a ratio to have other income to go ahead and use that income for whatever you actually need to use it for. Now, back in the day, around 2008, like prior to that, right? The answer was, it used to be when you walked into a bank and said, for example, hey, my name is Tommy. I work as a waiter and I make 100K. They wouldn't verify anything. So you can actually go ahead and walk in, get a loan for a house you can't afford. And before you know it, we had a big financial crash. And then you guys know how that story ended, right? A lot of people lost basically their houses, a lot of money, and that is not something you can actually do today because basically there are laws in place to make sure that does not happen. Now, for all of my visual people out there, Tommy, show me a real example, okay? Because I just can't get over all these numbers. In reality, here is how things actually work, okay? Let's say, for example, I want to go ahead and buy this home right here. This right here is a home in Fort Myers. By the way, I'm actually looking to buy this home right here. I'm always looking for things out there, and the home is awesome, right? It costs around $375. It looks great. It smells great. I'm just kidding. I haven't smelled the house. That would be really, really weird. But the answer is the home looks pretty awesome, right? $375. So what would be the math to see if I can actually go ahead and qualify for this home right here? Well, the answer is simple. And by the way, I actually included this entire Excel sheet in my entire description down below. So go ahead and download your own copy. Don't request permission. Just go ahead and download your own copy. So in this case, okay, all you want to do is type in exactly how much money this house actually costs. In this case, it costs $375, and I already put the number in there. But then the down payment section right here tells you exactly, hey, if I put down 3.5%, how much money do I need? 13K. 20%, 75K. 30%, 112K. Usually, I recommend you put down 20% on that mortgage. That way, you have some equity built in already. Also, keep in mind, okay, this right here to this side right here is your rate. Rates right now are historically low, so anything in yellow, don't change. But everything that's not in yellow, you can actually go ahead and change. So for example, if rates get lower or higher, go ahead and change this, okay? It's fine. On top of that, your closing costs are around 5% or 2% to 5%. Usually, I want to go high. That way, I have extra money. So in this case, I need around $18,000 to actually close on this property. By the way, don't touch this. It also changes automatically, okay? Don't worry about it. But then, right here, it tells me, hey, what is your mortgage? In this case, if I put down 20%, my mortgage is going to be around $1,213. On top of that, my insurance $175, my property tax is $375, and this way, my total cost is around $1,763. If you want to basically rent this property out, just put that in there. It tells you exactly what your cash flow basically is, okay? That is the core idea. Okay, Tommy, I get that. My mortgage, my insurance, my taxes, all this stuff. But how do I find out how much income I need to qualify for this property? So in this case, this sheet tells you exactly how much money your front end basically is, okay? What your mortgage is and how much income you actually need to actually have it. In this case, it's $49,217 based on a 43% debt to income ratio. But again, an FHA loan might give you a 50% ratio, but in this case, we're going to be very conservative and put it at 43%. Now, also, when you go to this slide right here, by the way, I stole this from Meet Kevin. I took his course and basically had this great entire sheet right here and said, you know what? Why not use this right here for my video? So in this case, again, don't touch anything in yellow. Everything changes automatically. And this again is based on a 20% down payment. So keep that also in mind. But in this case, guys, okay, say for example, you have this property, okay? The mortgage is $1,200. $1,200 divided by 43% gives you $2,822. Basically, how much income you need to take care of that, and also multiply by 12 to know exactly how much your annual income basically needs to be. In this case, you need around $33,000 to cover a $1,213 mortgage, okay? So debt is extremely expensive to actually own. The more debt you have, the more income you're actually going to be required to actually have also. On top of that, okay, just by this, okay, let's say you don't have any more debt out there, you need around $49,217 to cover all of this, okay? But let's say, for example, hey, I have a credit card, I pay $200 over here. I have a student loan, I pay $500 over here. I have, for example, a car loan, maybe a personal loan, right? I pay like $200 over here too. Or for example, a car loan, I pay $500 over here. Well, now you go from only needing $50K to now you need around $90,000 to actually go ahead and afford this mortgage. And that is what the underwriter is going to do. So usually that's why I recommend you have no debt when going into a property. This way you don't need to have that much income. Now, full transparency here, guys, okay? When I was doing this initially, I did have debt on credit card. I did have student loan debt. And also, I was looking at houses in New York, well, multifamily houses for around $700K, meaning I would need an insane amount of income, okay? So usually, it might mean, hey, maybe depending on your area, you're better off renting for the meantime, okay? Just rent for a while if the numbers don't make sense. I'll link a video down below on basically this sheet I showed you. Also, a rent versus buy calculator. And on top of that, also a video all about the different types of loans that are actually out there available. But by the way, usually I recommend whenever you buy a property, make sure you have a 20% down payment. Also, make sure it does not cost more than 33% of your income every single month. Meaning, if my income is $5,000, right, 5K, multiply that by 0.33, meaning I don't want to spend more than $1,650 and that property on the mortgage. This way, I have enough wiggle room to cover all of my other costs, which is basically also what the bank also wants from you. So overall, okay, your credit is important, but not that important. Having bad credit is the worst thing though. Also, for example, your debt to income ratio, how much income you actually need to pay for that debt is extremely important. So usually that's why I say your first step is to get out of debt, okay? That's why you don't want to have debt when it comes to owning a home, because then it adds a lot of complexity to the entire issue. I know people with a $700K home with 2 car payments, a bunch of credit card debt, and they're basically up to here. Any moment, they lose your job, and boom, everything is gone. And I don't want you to be in that place. And by the way, they put down like 3.5%. In reality, also a bad idea. On top of that, obviously, they're going to ask you for confirmation on every single document. For example, hey, show me your tax returns, your income for the past 2 years. This way I can get an average of what your consistent income actually is. They do not care if you have, for example, a 100K income this year, but only a 20K income last year, because basically they're gonna go ahead and take the average. This way they know exactly what your average income actually is. Okay, they take the average of 2 years, look at your tax returns, and look at all your papers. This way they know for a fact, hey, this person is not a high risk client. And guys, that is basically it. So when you walk into a bank and if you follow all these rules, you will be a textbook customer to go ahead and qualify for a mortgage. Well, good income, basically a good budget for a house, also good credit or no credit, we'll do manual underwriting, and also not having a ton of debt. That will put you in the clear. And by the way, you can't just go ahead and say, for example, hey, I'm going to buy a house that's so expensive, because usually your personal home is going to be a liability. It won't make you any money, but over time, it'll be cheaper than actually renting, okay, in the long run, okay? So just make sure to run all the numbers. All the links are down below. This way you have all of your resources. And I'll see you guys next time. Thanks for watching. And if you like this video right here, guys, well, like this video. On top of that, also, if you're new here, subscribe and hit the bell so you're notified when I post a new video every single day. And on top of that, if you want to text me or talk to me one-on-one, join my Patreon, link down below, or send me a DM on Instagram at TommyBryson. And before I go, if you want to watch a full video on all the types of loans you can actually get out there for a mortgage, the answer, well, for a house, the answer is here's that video right here, and click my face right now. I'll see you guys tomorrow. Thanks for watching, and as always, peace.